Enough?
Hi, everyone. We are going to start probably right at the top of the hour. So welcome to the first in our series, the Business Owner Toolkit series, taking advantage of the Employee Retention Tax Credit. So we'll let everybody kind of filter in and we'll get started soon. All right, we'll go ahead and get started. Good afternoon, everyone, and welcome to our webinar today. My name is Mary Verano, and I am the marketing coordinator at Corrigan Krause. I will be guiding the discussion today. Thank you for taking the time to join us as we share the first installment of our Business Owner Toolkit series, taking advantage of the employee retention tax. Our goal today is that you walk away with a clear idea of what the ERTC is and how you can take advantage of it if you're eligible. And there are obviously some stringent eligibility requirements. We have two incredible speakers today, Tommy Suster and Gwyn Broski, both from Corrigan Krause. I am going to have Tommy and Gwyn give a brief introduction, and then we will go over a few housekeeping things before we get started. So Gwyn, why don't you start us off?
Hi everyone, I'm Gwyn Broski, as she mentioned, a tax manager here at Corrigan Krause, and I work primarily on small, closely held businesses and their owners, and then our group of nonprofit clients. Corrigan Krause is a CPA firm with 3 locations here in Northeast Ohio, and again, we serve the closely held businesses, their owners, by providing tax, audit, and consulting work. We help clients with any kind of financial issues they may be having, help identify what their goals and objectives are, and provide solutions.
Great. All right, Tommy?
Sure, thanks. Hi, my name is Tommy Sustar. I'm a senior manager in our Assurance Services Department. I've been with Corrigan Krause for about 1.5 years now. Prior to that, I spent 11 years at a Big 4 firm, another 3 at a national firm. I work primarily in our manufacturing niche. I lead up our manufacturing niche, working on clients for compilations, reviews, and audits. I'm also a part of our CK COVID crisis team. I started in March, right prior to COVID, so I've been helping clients with PPP applications, PPP forgiveness, and then moving right in here to the employee retention credit.
Always exciting, always changing. All right, before we get started today, I wanted to go over a few housekeeping items. First, we want this to be a more interactive discussion, so please use the chat function or the Q&As to submit your questions, and I will ask them throughout the presentation to both Gwyn and Tommy. We are recording this webinar, and I will post this recording and the PowerPoint slides on our social media, and all of you that are online today will get an email with all that information in it to share as you see fit. If you'd like to become part of our email list, please email info@corrigankrause.com, and you will get about 2 emails every month of the latest news and information on our upcoming events. All right, with that said, Tommy, why don't you kick us off? Can you give us an overview of what the Employee Retention Tax Credit actually is?
Sure. So now that companies have exhausted the funding of the PPP-1 and PPP-2, companies started to look at other COVID relief options that were out there. And so the Employee Retention Credit was one of those things that it wasn't talked about as much last year, and now it's on the forefront for a lot of companies that are trying to get extra COVID funding. So what is it? So it's a refundable federal payroll tax credit that could be worth up to $33 $33,000 per employee per company during 2020 and 2021, if you qualify for all the quarters in that period to take the credit. Now, to be eligible for the employee retention credit, you need to be a privately held business, and you're held to some headcount restrictions for both 2020 and 2021, and you must have had a significant decline in your revenues or some type of partial suspension of operations. It was really designed to help provide relief to companies that kept people on board during the COVID impact that we all felt from. So it's trying to help you with a little bit of a federal refund to go with that. So it could be claimed in both 2020 and 2021, depending on how you qualify.
Got it. Okay, so Gwyn, the ERTC has been part of 3 different pieces of legislation in the last year and a half. Can you walk us through the history so we know we're totally up to date on which iteration we're in now?
Sure. So the employee retention tax credit isn't new. It's been around for a few years. Before kind of COVID blew up in 2020, the credit was typically utilized by employers who are operating in kind of a qualified disaster zone. So, those impacted by like wildfires, hurricanes, those types of situations. The rules pertaining to how the credit was used then, people are getting much smaller credits than kind of what's available out there now, since COVID has had such more global impact. But the first revision to the employee retention tax credit came in the CARES Act, and that was the first kind of relief bill that was passed by Congress on March 27th of 20. And with that act, we got the PPP funding and other things that came out of that. But the big asterisk was if you received PPP money, then you were sort of automatically disqualified from getting the employee retention credit. And then as we kind of moved through the year and people started, using up all the PPP funds, we saw a second bill get passed, the Consolidated Appropriation Act, in December of 2020. And this act went and extended the credit into Q2 of 2021, and it changed the amounts that you could use for qualified wages. It kind of reset the $10,000 cap from every quarter that we'll kind of get into. But the most important thing that kind of came out of this act was that now an employer who received PPP funds, used it up in the allotted time they could use it to qualify for forgiveness, could also now take part in these credits, to help with cash flow and keeping employees on the payroll. So the caveat was that you could use kind of wages for either PPP forgiveness or for this credit. They just kind of couldn't count for both. And the latest act that was passed, the American Rescue Plan, further extended the credits all the way to the end of 2021. And it made some changes kind of going forward on how it will work on the 941 forms for Q3 and 4. Currently, it's being applied against the employer portion of Social Security tax, but for Q3 and 4, it's going to start applying against the Medicare tax. And as Tommy said, that the limits have been increased, and now you can kind of get substantially more for your employees. It also changed some wording on if you have a recovery startup business, and those are kind of defined as an employer that began, carrying on a trade or business after February 15th. And it talks about, annual gross receipts up to 3 years before this period, couldn't exceed $1 million, and you could kind of qualify. But it does note that for these recovery startup businesses, it's going to limit your employee retention tax credit to sort of $50,000 per quarter is what you'll be capped at.
So when it comes to the changes there, is there an amendment that you can make to previous quarters, or is there after this date, now you're qualifying for, especially like with the difference in Q2, 3, and 4 of this year, is there it's like a hard date where things switched over, or is it something that you can amend? How is that working?
Yeah, so with the changes of each law that's been passed, each version had a different set of rules, and the rules kind of to the game kept changing. So with the passing of these different acts, you could kind of go work retroactively and amend things that were already filed to get credits. And, for some of our clients now that we previously thought wouldn't qualify for this, these credits, we're going back and we're amending previous quarters, Q2, 3, and 4 of 2020, and then kind of working proactively forward to make sure they're still qualifying for these credits to get them on returns they're filing currently instead of working backwards to amend.
Got it. Thank you, Gwen. All right, Tommy, what are the different eligibility requirements from 2020 to 2021?
Sure. So they're similar but different when looking at each of the years because it is based on a revenue decline, and then the other option is a partial or full suspension of your operations in both years to qualify. But to qualify in 2020, you need to have a 50% or greater decline in gross receipts for one of your quarters in 2020 compared to 2019. So if we're looking at, for example, the second quarter of 2020, you compare to the second quarter of 2019. You can't just pick any one of the quarters that you want to show a 50% or greater decline. It has to be that same comparable quarter. And technically, a small portion of the first quarter of 2020 could be taken for the credit since they count COVID starting as of March 12th, 13th, and somewhere around that as far as taking the credit. So you could get a little bit there. And then the other option is the full or partial suspension of operations due to government orders. So I will say this is a little more of a gray area for some companies. Certain government orders are very clear as far as what that is, and there's also some other gray areas that companies can try to take these disruptions. So if there are government orders that you had to cease operations or the business wasn't allowed to operate in the same capacity as they were before, this would be a partial suspension of operations. For example, in Ohio, when Governor DeWine said certain companies starting in mid-March through different points in 2020 weren't allowed to operate normally. Say, for example, gyms weren't allowed to operate at all during a period, but then they were allowed to operate at limited capacity. So this could be an example of a full suspension during the time that they were not allowed to operate at all, and then partial suspension during the period they were allowed to operate but at a lower capacity because they were restricted on hours, they restricted a number of people, so those types of things. So the partial suspensions are certainly something that you need to work with us to try to help make sure that you truly do apply for those partial suspensions, because not every circumstance due to a change in your business from COVID automatically qualifies you for that. So if you just had to go home and work remotely and you were able to do your job without any problems, but you weren't able to come to the office, that's not a partial suspension of operations. So some service type firms, that may not qualify because really all that changed was instead of being in the office every day, you were on your laptops at your home and you were using Zoom and Teams more often. And so that's not considered a partial disruption of operations or suspension. So something to consider, and you'd want to work on that. Now, it doesn't have to be your entire business was changed by COVID regulations or government orders. They say it needs to be more than a nominal part of your business was disrupted. And what a nominal part of your business is defined as is more than 10% of your revenues are related to that disruption. And so, the other thing is when you're looking at these disruptions, you start with government or orders that specifically define that the business wasn't allowed to operate at a certain level. And that's what we could take a look at. And when you're looking at 2020, one of the main differences as far as the amount of the credit that you're allowed to take is in both years, it's up to $10,000 of wages, which does include qualified health care paid by the employer, but you only can take 50% of this for the credit in 2020 for the entire year is the limit for that. You also can only have 100 employees to be eligible for the employee retention credit in 2020. There is a small area that you could be eligible for if you have greater than 100 employees, but it's limited that technically you were paying people that weren't working. So you had sent people home, but you continued to pay them during your shutdown. So that portion would be eligible for the retention credit. But if you were part of the group that was continuing to work, that would not be eligible if you have greater than 100 people. So it's a very limited basis that would qualify for if you had greater than 100 employees. And then the other thing is as far as the headcount. So this is different than what we saw with the PPP. They're looking at a different measurement as far as what is considered your full-time headcount. It's based on your 2019 headcount, and it's 30 hours per week. it's not based on how many people you had in 2020 or 2021. It's how many people you had on average for the full fiscal year of 2019 to determine if you were at 100 employees or less.
Got it. Okay, a couple questions. Is there a specific way to be calculating the suspension? And if we're going to talk about this later, you can just say that. But is it a percentage? So if I was closed and then I could only operate at 50% capacity if I was a restaurant, or if I had limited hours and it was a third of the hours I was usually open, is that how I'm quantifying my suspension or my loss, or is it based on revenue loss completely, regardless of how closed I was?
So I think it could be a combination of either of them. So for, if you look at your company and, if you're a restaurant and you can only operate outside, I think even if you had good business, it'd be fair to say that that was a substantial portion of your business that you had to close. And so you had the partial suspension of your operations. I think they're just trying to get companies to look at that. It's not just, oh, I couldn't do this small thing with my business anymore, but it was something that directly impacted the way I had to operate as a company. So I think that's the way to look at it. The 10% revenue mark would help with certain things, but there also are things such as like supplier disruptions that may not be easily measured by your revenues. And then the other thing to keep in mind when you're looking at this, you need to have a beginning and an end date for when those suspensions happen.
Okay. And then when it comes to revenue changes, if I was a store and I managed to go online and then still kept about the same amount of revenue, is that, or do I not qualify anymore, even though I was suspended or I was closed, but because my revenue didn't reflect that, then I don't really qualify for this?
So no, if you had a storefront that you typically operated on and you were not able to have that, you weren't allowed to be open due to government orders, and you still had online sales, you would still qualify because you had that storefront before and you were restricted from that. If you chose that like demand was just down and you didn't want to do it, that would be different. But if the government stipulated that you couldn't operate that storefront anymore, but you still had online sales, you would still qualify based on the fact that you had traditionally had that storefront.
Got it. Okay. Now I think it's safe. Let's move into what's going on in 2021.
Okay, so in 2021, things become a little more lucrative for companies. So in 2020, the one thing is, so you were able to get 50% of your $10,000 of wages to get approximately $5,000 per person. But that was capped at the entire year. So even if you qualified for every one of the quarters during the course of the year, the maximum you could get per person was $5,000. When you look at 2021, you can get 70% of someone's wages here, up to $10,000 for every quarter. So this is where it gets to be, it's approximately $28,000 or $28,000 per person if you qualified for every quarter compared to $5,000 year before. And then the revenue decline also becomes way more favorable for companies. Instead of being a 50% decline in revenue, now it's a 20% decline in your gross receipts when looking year over year. So that really allows a lot more companies to potentially qualify for this because the 50% was quite a hurdle for some companies. And so if you meet the 20% decline when you're comparing the first quarter, say in 2021 to the first quarter in 2019, that would allow you to take that credit for the quarter. And the other things that are beneficial to companies here is for private companies now, instead of having it be that it was 100 people that you were required to have, it's now 500 people or less. So that really opens up a lot more companies that are allowed to take this credit now that were restricted before to 100 people or less. So, it's really a lot more beneficial to companies and offers a sizable credit that could be taken every quarter during the course of the year.
Right. Okay, just a reminder for everybody, if you have any more questions, please use the chat function, use the Q&As. Tommy and Gwyn are here and are very happy to answer any questions that you might have. All right, so getting a little bit more into the suspension of operations, can you expand on what all of that means, Tommy, full or partial suspension in operations due to government orders?
Sure. So this is definitely With certain things, it's a gray area, and we've worked with some clients now about the partial full suspensions, and a lot of people are hearing that they think they qualify no matter what for these partial suspensions due to different firms coming out there trying to get the credits to be taken. But I think you need to be careful of whether you truly had a partial suspension or a full suspension of operations. I think the best way is to go through a few more examples of these, but I will say there's not a full list of examples that are out there that the IRS has that encompasses everything. There's certainly going to be times we're going to have to try to connect the dots to see if it makes sense based on the guidance that is out there, whether you could qualify for these credits. But a few examples to get you thinking of more of what would have allowed you to qualify for the partial suspension of operation. So, restaurants is one. I think we all see that they were closed for that period of time from starting in March through sometime in the summer, depending on the type of business that it was. There was takeout, but they weren't allowed to operate indoors. And then there was limited outdoor capacity. So that was a partial suspension. Now, say a dentist office or an eye doctor, that wasn't doing anything with COVID related patients, they were required to be closed towards the end of March through sometime in May, at least in Ohio. And so they had a partial suspension of operations based on that period of time, or a full suspension of operations. It depended. Some companies were seeing certain patients here and there, but you would have a beginning and end date for that, and it would allow you to take that credit during that period. The key again here is that you had to have been paying people during that period. Now, if you're that doctor's office and you opened up after when you were allowed to, based on the guidance from the government, and the government had stipulated that you could only operate at 60% capacity or 80%, you had to have less patients. So maybe you didn't meet that revenue decline, but you were restricted on how many patients you were allowed to see in the course of the day because you had to do different types of COVID cleaning, or you couldn't have as many people in the waiting room, or a variety of things. And so that's where you could start to see, okay, well, you opened, but you had this partial suspension, and that could be a period that you're allowed to take that credit because you weren't allowed to be open at the maximum that capacity you normally would have done. Another example would be that we've done recently is a law firm. So a law firm similar to an accounting firm was able to go home and do their job and work in professional services environment online, but they couldn't appear in court for a period of time. So by not being able to appear in court, there's a portion of their business they weren't able to operate in. And in that case, there was a clear start as to when, based on the state rules, they were no longer allowed to appear in court, and then an end date of when virtual court appearances were allowed to happen, and even in-person court appearances started to happen. So in those cases, you would have a partial suspension of operations. And another example here that people don't think of as much as manufacturing companies. So your suppliers. So if you have a supplier disruption for your operations that was caused by a government shutdown, you could apply potentially for this. So maybe you didn't have the disruption here due to a restriction you're allowed to operate, but you were getting your supplies from companies in Michigan or Pennsylvania that had much more intense restrictions than we did in Ohio. And because of that, your supply chain is off. It could still be off. There are companies that we're working with now that continue to have supply chain issues. And so we're working with them on how to claim those partial suspension operations credits here, because they're continuing to have problems getting certain types of products. And it's a variety of products that people are having trouble getting lately, because that period they were shut down or slowed down, it's starting to catch up to a lot of companies. And so getting those supplies has caused for a disruption in your supply chain. And so you qualify for that period. Now, the key though is determining what that supply chain issue is, when it started and when it ended. And we work with clients to put together memos to document emails from their suppliers, issues, those types of things where they can't do those. They can't do what they were doing before because they can't get the supplies. And we can start to build a case of how you have that supply chain disruption. It's not always clear to see right away, but as you start to ask some questions, you can see that it's a possibility they could have that partial suspension. So that's something that I think a lot of manufacturing companies and other companies as well could start to think about that line of thinking that could qualify you for this. So, one thing I wanted to make sure is during these suspensions, you had to have been paying wages. So you can't just claim it for a whole quarter. It's only the period you have the suspension, and then it's only if you actually paid wages to people during that time. And so it's very important that you continue to pay people to claim this credit. The other thing that I wanted to mention with partial suspension of operations, so a lot of things changed with demand during COVID, right? Certain products were thriving and certain things people didn't want as much. Now, if your business felt a decline because people weren't shopping as much at your store and demand went down, that does not qualify you for the retention credit. You qualify based on revenue decline. It's not just that we weren't coming to your store as much because we were at home. You would have had to qualify in the revenue decline because according to the government, you were allowed to continue to be open. So it's important to really make sure that your suspension lines up with what the rules are overall and think about it like that. A lot of services companies didn't have disruptions from going virtual. So they, at first glance, would not qualify based on that. So it's important to determine what happened to your company as to why you qualified. It's not just that you started working at home that would make you qualify for this overall. So it's really pointing back to government orders, changes in requirements for your business or your suppliers or things like that that allow you to ultimately qualify for this.
So speaking of moving businesses home or to home, at least temporarily, if a company was able to move their services to be remote, but there was a lag time there of either getting the technology they needed, getting their people trained, or something like that, where there was from March 17th to April 15th, we lost revenue because people were getting set up at home, but then we were able to pick up. Would that be considered, or would that qualify for the lost revenue?
It wouldn't qualify for lost revenue. It could potentially qualify for partial suspension of operations. It just depends as to what extent or what changes you had to make to refit your business, and was there something that you were no longer able to do by going virtual. The lost revenue is based on how much your revenue was for that quarter. But as far as making those changes, if you had to make significant changes or you weren't able to do a portion of your business, that may qualify. Even
if it's for a short period of time. So it doesn't have to be months and months. It could be a few weeks.
Yes, exactly. So I know I've done for some companies, it's been like 3 weeks that we've taken the suspension for, like, or 5 weeks, something like that. And it does not have to be extended period of time that you qualify. Certainly you need to have a payroll run during that period, but it could be a short period of time that we could ultimately point to take that credit based on the facts.
And when it comes to the supporting documentation that you need, how detailed and deep does it need to be? Does that have to go straight to the IRS, or do you claim the credit and then hang on to the proof in case you're audited? How does that work? Because I'm sure you need proof. Right.
So it's a lot. It's in case really that you get audited by the IRS that we're doing it. So when we're submitting, and Gwyn will talk more about amending the 941 ultimately takes the credit, we're not submitting what that partial suspension of operations is necessarily, and the support that all goes behind it. Sometimes they ask what the quarter or maybe a revenue decline or things like that, but it's really in case you get audited in the future by the IRS that we want to have that case built for you, that we agree with you collectively that you did have this suspension, here's the support for it and why. Because if it happens a couple of years from now, you could ask about it, it may not be as easy to find that in the future to support that. So what we're doing is advising clients, and it's not an extensive memo, it's really just the fact pattern is these are the things that happen, this is how it happened, and then what are some emails you have, can you document some conversations you had with different people, and then if it's certain government orders, we can find those and we can put those in the file as well. But it's really building that case so that one day if the IRS catches up from being extremely behind and they audit you, that we'd be ready to defend our case and why we took that partial suspension of operations, because we don't want to take this credit for you unless we believe it's in line with what the guidance has for the IRS.
That makes sense. So are there any special rules? And as you can tell, there definitely are. So can you walk us through the special rules that folks need to be cognizant of before they start saying, yes, I can take these credits?
Sure. So There are some special rules that happen. So there's different rules in 2020 as well as 21 as far as these unique rules that happen. So in 2020, and it's the first thing that's listed here. So you qualify, for example, in the second quarter of 2020 based on a 50% decline in revenue. And now if in the second quarter you were down 30%, sorry, the third quarter you're down 30%, you continue to decline to qualify for that because it goes that you are eligible for it as long as you have not come above 80% of your gross receipts for the same quarter in 2019. And it just means in general that you're going to get an extra quarter or two in 2020 by qualifying for this. And so potentially you could qualify based on a 50% decline in the second quarter, and you could end up qualifying for the rest of the year, even though any of those other quarters did not meet the 50% decline. So it's something to keep an eye on. You'd have to get above that 80% of your revenue, and then you still get one more quarter to ultimately qualify for that. And then the other rule it's kind of unique that, we're looking at 2021 and it's 20% revenue decline is the way to look at it for comparing to 2019. But the IRS does have this alternative quarter option. And what it is if you look at your 2021 first quarter revenue decline and it's not 20%, so you don't initially qualify. But if you go back, you're allowed to go to the preceding quarter to see if you had a revenue decline of 20% or greater. So when you're doing that, that is the fourth quarter of 2020 compared to the fourth quarter of 2019. And if you're down 20% during that period, you can take the credit in the first quarter of 2021. It's kind of confusing, but that's the way it works. So when we are looking at these for clients, we're looking at the revenue for every quarter for that 3-year period to see different ways that you might qualify. And we've had clients get the credit in the first quarter of 21 based on this alternative quarter option. Now, the restriction is so if you qualified based on a revenue decline in the first quarter of 2021 of 20%, you would automatically get one more quarter, right? So you get the second quarter. If you do this alternative quarter option, you don't get that extra quarter. It's still great that you're getting it, but you don't get the extra quarter that you do if you qualify based on the normal revenue decline. And we can certainly help explain that more to clients. So that's why when we analyze these, we're looking at the full revenue for the whole entire 3-year period, because some clients think they have not qualified because they didn't meet the 20% in 2021. So there are other ways that we can try to work with you to ultimately meet that. So the other thing here are these related party rules and controlled groups. So there are some related party rules that are surprising that cause some restrictions when you're taking the credit ultimately. So if you're a 50% or greater owner in the business, you're allowed to be included in the retention credit. Your spouse is allowed to be included for taking the credit. But if you have a brother, sister, you have your children in the business, they are not allowed to be claimed for the credit. So when we're looking at these credits for clients, we're making sure that we had 50% or more owners, and then any related party relationships that they have, and those may have to be excluded ultimately. It does not matter if they've worked for the business for the last 20 years. They are explicitly excluded from being a part of the retention credit, but an owner's spouse is allowed to be included in the retention credit. And this only applies for 50% or greater owners of a company. The controlled groups is something that trips up some people when we're looking at this. So you may have a group of businesses that you own and operate, and one of them was down significantly. And so you meet the revenue decline in that business, but when we look at your other businesses, they had a good year, or they broke even, or it was close. And so if the ownership is consistent between a group of entities, we can't just take the credit for one and ignore the others. We have to, it's called a controlled group, and you have to group those together ultimately. And we look at your revenue decline in the aggregate basis. The benefit to this could be that if you did qualify based on that group, you can take on all three of them. So you could have had a huge decline in one of them and smaller on the other ones, and it allows you to take a bigger credit in the end. But it is a bigger hurdle that all of the companies have to be grouped together to ultimately take this. If you have a partial suspension of operations, that can be taken differently for the actual company that applies to. It doesn't have to be the aggregate for that, for a controlled group. So that's something to pay attention to. But as far as revenue decline, you would have to look at that all together. The next big thing is the PPP versus the retention credit. So, we've had companies already apply, or you may have already had to apply for PPP forgiveness for round one. We can't change the application that you already submitted. So wages that you included on the PPP forgiveness application cannot be claimed on the retention credit. But the thing to mention here is that when we were doing applications for clients before, your loan might have been $100,000, and we were putting $200,000 of wages that you had during the period, because that's how much you paid in your 24-week period. You're only restricted to not being able to use the wages you were actually required to claim on the application. So that extra $100,000 in this case could be used for the retention credit if you qualify. You can't change the buckets of things that you had on your application though. You can't say, oh, I would have used more rent, I would have used more utilities. If you went all payroll, you've got to keep it as all payroll. You're just restricted to that. So that's more for PPP1 since it's already been applied. When we're looking at PPP2, whenever we're looking at these retention credits now for the first, second, and now is going to the third quarter here, we're asking for their PPP loans, and we're trying to be strategic with how we use the wages for PPP, as well as claiming the most possible wages for the retention credit. Because now that we have the ability to manipulate that, we could include some more non-payroll costs. We could manipulate what we're using for the retention credit and maximize both these programs to the fullest extent. It does take a little more time to do it, but we're talking about several thousands of dollars, hundreds of thousands potentially, that we could get clients by sort of manipulating those two programs together and finding the maximum amount for both of these programs to do it. So it just takes a little bit of work, but you can use both of these programs effectively. And then there's still the other COVID relief programs that are out there. You can't use the same wages for two programs. This is the best way to look at it, is if you're using wages for the family's FFCRA or anything else, you can't use it for the retention credit. You can't use it for the PPP. Each program is sort of exclusive. There's no overlapping or double dipping of wages ultimately. So really be careful with what you're using these for. That's kind of your main restriction on what you're ultimately allowed to do. But you could have tremendous benefit if you strategically work through these different programs.
All right. Thank you, Tommy. A lot to consider there. Gwyn, now that we kind of understand the rules of the ERTC, do you think you can walk us through how to actually claim it?
Of course. So as Tommy said, what he's been doing is really analyzing and working with clients to sort of determine if they're eligible. Once they're sort of determined to be eligible, we start pulling payroll reports and seeing exactly how much of the credit we can calculate for them. So there's a couple different spreadsheets we've been doing and kind of breaking it down by employee of, who's qualifying each quarter, what those wages look like, and then also requesting copies of the originally filed 941s, because a lot of times we have to work backwards and amend in order to claim these credits, because especially with 2020, initially we thought they weren't going to qualify, now they are. So once we kind of get that, we can go ahead and amend the 941. I know a lot of clients use payroll providers that are out there. They also have the ability to amend the 941s. But what we've been noticing kind of out in the marketplace, where there's opportunity for big dollars to come back from the government, you get, people that are ready to take advantage of that. And some of the payroll companies have partnered up with these outside third-party providers where they will look at your situation, look at your revenue and see if you qualify. But sort of the caveat with them is they're going to take 20% of your credit, and that's how they're going to be paid for their fees. So you kind of have to watch that's out there. We can do it obviously much cheaper than that, especially when you're a company that's getting maybe $100,000 refund back to you. These third parties would want, $20,000 of that to provide a service that doesn't really cost, $20,000 to provide. So just be aware, these third-party companies are out there, but they're basing on a percentage of what your credit is to get paid, which I don't quite think is right, but just to be aware of them. So once we determine that you're eligible and we get all your previous quarter's amended, we want to work on a go-forward basis to make sure you still qualify in future quarters, because we would like to get that information on the return as it's being filed, because everyone knows the IRS is significantly behind, and they are going to be behind probably for the foreseeable future. And they're on a processing delay time of about 6 to 8 months to get these credits back. So the sooner we can get them on the currently filed returns, the better, because the originally filed 941s, they can all be e-filed, which means they're going to be processed much faster that way versus the amended ones that all have to be paper filed, and they're going to go sit in some lockbox at the IRS, and you'll eventually get that check. At this point, you're looking Christmas, New Year's for some of the clients that we've already filed. So the sooner the better, we can get that information on there. If we have to amend, you're still going to get your credit. It's just going to take a bit of time for it to come back to you. And that kind of stuff. And then just kind of a shameless plug for us, we've done quite a few of these amended returns and worked with our clients. And, at this point in time, we still have more work to do. But at this point, we've gotten back just about $4.5 million for our clients, with the average refunds coming back of about $133,000. So definitely big money that's still out there that we can work with you to get back for your organization, that you can kind of use in the future.
So what is the best way for someone that might be listening right now and saying, oh, the Corrigan Krause team really has like the experts, and we have Gwyn and Tommy here, two of our experts in this. What's the best way for them to start working with our team then?
Right. So the first thing we do is reach out to me, reach out to Tommy, even the info at Corrigan Krause if they're not one of our current clients. Reach out to us and we can start looking at your situation to see if you're eligible, and then we can just kind of go from there.
Yes. We just had a question pop in, which is why I was slightly startled there. Question coming in is, if two siblings own a corporation, so not a husband and wife, are they each considered to indirectly own each other's shares?
I think it depends. They may not be. It depends if they're considered to be similar types of operations and they're controlled together in a sense. If they're totally different types of businesses, I would think they are not. I think it depends on the circumstances of it.
Okay, so that would be a situation where you would definitely want to contact an expert in the ERTC realm, and that would be somebody at Corrigan Krause, of course. So we have Gwyn and Tommy available here. So if you have any other questions, please go ahead and either use the chat function like our wonderful person here just did, or the Q&A function. While we wait to see if we have any more questions, I just want to thank Tommy and Gwyn. All of this has been really helpful. There's a lot of details here, and we are here for you, business owners, for sure. This is a lot to work through. We have a team ready to help. And it looks like the last bit here is what does it take to become more of an expert in the ERTC? So if somebody is out there that is working, what can they do to kind of brush up on their information? Like, where are you guys getting the information and keeping up to date?
So there's certainly, some literature the IRS has out there. There's the employee retention frequently asked questions section that is out there. I think that's got a lot of good information. The trouble is it's not fully updated for a lot of the changes that they've had. There are certain links that have some information. It will give you at least a great general overview of how it works, but they're a little behind updating it fully. It's got some examples of partial suspensions, special rules, that type of stuff. I think that would be one way to do it, but you could certainly have conversations with us that we would be happy to explain, how things work, understand your business, and how we can try to help you overall. But if you're doing some research first, that's definitely a place that I've spent some time looking at.
Great. Well, I think that is about it for us then. Again, email us at info, INFO, @CorriganKrause.com. Go to CorriganKrause.com online, and that's the best way to find all of our contact information, including Gwyn's and Tommy's. We really appreciate everybody coming and asking all of those great questions. We have upcoming events. So if you look at corrigankrause.com/events, you'll see our other upcoming events. And otherwise, please let us know if you have any questions at all about the employee retention tax credit or anything else. We are definitely here to help. So thank you, Tommy and Gwen, and we will see everybody next time.
Thanks.
Thank
Thank
you.
you.